Hi there, welcome to Kneppy Invest. Almost into the top 10 of the best performed ASX companies since 2013. But before we get to the top 10, we have to go through those companies that came in between 15 and 11. And to be honest with you, even though the four of these companies are not a surprise to be on this particular top 30 list, there is one company I was absolutely shocked that it made it not only to the top 30 but the top 15. In fact, this company came in at 11. And I just didn't believe it. When I saw it on the list, I just could not believe it. And then I looked at the chart, and you'll come to understand why and how this particular company came in the list at number 11. But before we have a look at these five particular companies, I'm also going to go through some important points, which I have touched upon in previous videos, but I believe it's probably a good idea to look at these points again. I'm also going to have a look at another five of the worst performing companies since 2013, and you will see a common theme among these worst performing companies. And then you will get into the list of the next five companies in the top 30 best performed companies on the ASX since 2013. Now, in regards to this list of top 30 companies, it's very important to note that this is not my opinion. In fact, if you're getting my opinion, I would come up with a completely different list of 30 companies. This is solely based off total analyzed returns over the past 10 years up until May 31st, 2013. So we're looking at share price appreciation or depreciation in some cases of the worst performing companies, plus dividends. You always got to take dividends into account. I used Guru Focus to come up with this list. Only companies listed since 2013. And that's very important as well. They have to have listed or been listed entity on the ASX for 10 years, which means some of the best performing companies in the last 5 to 7 years have not made it onto the list, including Wise Tech. And I only wanted to include non-mining and revenue generating. So quite a few mining companies would have made it onto the list, including Pilbara and companies like that. And the reason I didn't want to include non-mining is because they tend to be cyclical. And if you just look at a 10-year period, you can catch the bottom of the cycle and the top of the cycle and come out with a top performing company. And the reason I wanted to use revenue generating simply because there is one particular company I'm thinking of right now, Neuren Pharmaceuticals, and we have seen the share price of that company increase significantly in the past year because of FDA approval. So I just want to make sure these companies are revenue generating. And maybe I should have only included profitable companies as well. And this actually will make sense when we look at I think it's number 14 on this particular list. And I only included companies with a markup above 1 billion Australian dollars as of 31st of May 2023. And I think I've already mentioned this in previous videos. There's not many really good performing companies with a markup less than $1 billion, which makes sense. If a company has been listed on the ASX for at least 10 years, it has performed really well over that 10-year period. More than likely, the markup is going to be above $1 billion. And if not, it's going to be close to being above $1 billion. And this is possibly the most important point when taking this list into consideration, that past performance is not a predictor for future success. And this is really important when we come to the company that came in at number 11, the company that surprised me, shocked me that it was on this list, because this company has performed really well over the past 10 years. But when you look at the long-term history of this company, if you bought this company back in, say, 2006 or 2007, you would be at a loss right now. Now, let's have a look at some of the worst performing companies on the ASX since 2013. And all these companies had a 10-year analyzed total return between about 3.5 and 3.8%, which, to be honest with you, is a fairly mediocre return over a 10-year period. And quite a few of these companies have fairly big dividends, which means the share price of many of these companies has actually dropped over the past 10 years. And it shouldn't be a shock, the name of some of these companies: ANZ, Telstra, IAG, and Fletcher Building. One company here I don't know anything about, and that is BKI Investment. But if you look at the revenue growth, earnings per share, and dividend growth over the past 10 years, really mediocre number. In fact, a lot of these numbers are negative. In fact, when you look at 10-year revenue per share growth, 4 companies are in the negative. Earnings per share growth, 3 companies are in the negative. And dividend growth, 4 companies in the negative. Another thing I always take a look at is return on invested capital. And when I have been going through the worst performing companies on the ASX, the majority of these companies have a return on invested capital or a return on equity less than 10. And this is a really good reason why I pay attention to this particular metric, because it does show you the quality of a company. Now we move into the list of 5 companies. And the first one coming in number 15 is not a surprise at all. And that's Fisher and Paykel Healthcare. Really solid revenue, earnings per share, and dividend growth, all between about 13 and 17%. That's exactly what you want to see in a high quality company. Nice gross margins and return on invested capital right under 20. And again, when you look at the growth and return on invested capital, return on equity, these are the numbers that suggesting this company is high quality. And it hasn't disappointed shareholders, with Fisher & Paykel Healthcare giving their shareholders a 24.6% analyzed total return. And if you completely held Fisher & Paykel Healthcare in your portfolio, say if you had 100% of your holdings in this particular company, you have done really well over the last 10 years. And as we take a look at Fisher & Paykel Healthcare's weekly chart going back to 10 years, this is a beautiful looking chart, particularly between 2013 and just before the COVID-19 financial panic. Now, there was an acceleration in the share price late in 2019, early 2020. And before then, the share price was just going up at a general beautiful rate, the sort of trend you want to see in a company that is within your portfolio. And usually when you do see an acceleration in the share price, either you need to see another acceleration or further acceleration in the financial growth of the company, or more likely what was happening in Fisher & Paykel at the time, there was multiple expansion. I do get a little bit nervous when I do see multiple expansion in a company, and that's the main reason the share price is going higher. And the share price did reach a high of $35 in late 2020, and the share price hasn't reached those levels since then. In fact, the beautiful nature, the beautiful look of this chart has been harmed because of what's happened to this company over the past few years. Now, saying that, this company was benefited by COVID-19, and that's why the share price did run up in late 2020, but also it has experienced some headwinds as well, because a lot of these hospitals have already bought Fisher & Paykel Healthcare products, and they don't need any more products. And that's why we did see the share price take a bit of a plunge in 2022, went all the way down back to $16 in about September of last year. And I think at $16, this, just looking at the long-term trend, not only the financial growth of the company, but also the charts, about at $16, this was absolute bargain. Now, the share price did rebound, went back up to $26. It did fall a little bit on some negative news a while ago, but we have seen a little bit of bounce in the last few weeks. So whether this company is good value or still overvalued right now remains to be seen. But if the company can maintain the growth it has experienced over the past 10 years, I do think the share price will be significantly higher in 10 years' time. Coming in at number 14 is Xero, and this was not a shock to be in the list at all, simply because where the share price was 10 years ago. This has been a hype stock on the ASX for periods of time, and you'll be able to see that on the chart. Now, I still remember 10 years ago, when this company first came on the ASX, it was maybe 11 years ago, there was a lot of froth around this company, even though it was burning through cash, was not profitable. It was all about the revenue growth. Now, I have on and off held this company in my portfolio, and one of the reasons I was trading this company was simply because I didn't consider it to be high quality because it was not profitable. But I did take a position in this company, hopefully for the long term, just based off the change in direction of the management. And they're more focused on cash flow and profits right now because that's what the market wants from all these companies. So more than likely, this is going to be a really good, profitable company in the next 5 to 10 years with really healthy cash flows, particularly if they can keep on growing their subscriber base. But revenue growth of 38.2% per year, that's absolutely fantastic revenue growth. Whether they could keep that growth up over the next 10 years, I doubt that. But we will see earnings per share growth and dividend growth. At this point in time, it's zero because this company has not been profitable in the past. Nice gross margins and return on invested capital is negative. But the analyzed total return over the past 10 years is 25% per year. And the reason you have received that sort of return is because the share price has increased. And the reason the share price has increased is simply because of that revenue growth and the expectations of the market that this is going to be a highly profitable, highly cash flow positive company in the future. Now let's have a look at Xero's weekly chart going all the way back to 2013. They listed on the ASX 2012, 2013. And I still remember 2013 because the share price of Xero went from $5 to about $40 in a fairly quick period of time. And there was a lot of excitement in the market around this company simply because of that revenue growth. Then that excitement died away for about 3 years. You can see the share price was really struggling between 2014 and the start of 2017. And then we saw the share price move into an uptrend. Not only did we see the share price move into an uptrend in the second half of 2017, we also started to see growing volume. And that growing volume was telling us that fund managers were becoming interested in this company. And during that uptrend, the share price of Xero went from $25 all the way to a high of about $160 towards the end of 2021. And then, of course, interest rates started to rise. Tech companies, particularly unprofitable tech companies, were out of favor of the market. And that's why Xero's share price fell quite significantly during 2022. In fact, it fell from about $155 to $65. Now, I was not a shareholder during that period. And one of the things I was waiting for with Xero was just change in the attitudes of management. I wanted to see that the management were more focused on profits and cash flow. And before that, they were more focused on revenue growth. And they made that change. And as soon as they made that change, the sentiment in this company went from negative to positive. And that's all the market was waiting for. They just wanted to see the management was being focused or was highly focused on profits and cash flow. And that's why the share price has gone from $65 to a current share price of around $120. Coming in at number 13 is another company I've held off and on over the past 10 years. And one of the reasons, again, just like Xero, I have held this company on and off is simply because you can't really consider this company to be high quality. And I only really prefer to own high quality companies for the long term. And the main reason I wouldn't consider Nanosonics to be high quality just yet is just the volatility in the company's profits and cash flow. But there is a lot of potential for this company. The market sees that potential, and that's why the valuation of this company is well above $1 billion, and why the analyzed total return of Nanosonics has been 25.2% per year. Nice revenue growth, 24.5%. No earnings per share growth, no dividend growth, nice gross margins. I probably would ignore return on invested capital just now, but I would expect that to improve over the next 5 years. So my expectations around Nanosonics are that the revenue growth will continue at fairly good rates, maybe not 24.5% per year, but this company will be consistently profitable and cash flow positive moving forward. And that return on invested capital will get to be between 15 and 20 in the next few years. Now, I'm not sure if the analyzed total return will match 25.2% per year. And I probably would expect that maybe to be a little bit lower. But I have taken a longer term position in this company just because my expectations for Nanosonics moving forward are quite high. We're not quite seeing those expectations being met in the financial numbers just yet, but I do expect that in the future. And I think the market also expects that. And just like most other companies in this top 30 list of best performed companies since 2013, a beautiful looking chart with the share price moving from the bottom left to the top right. And for a lot of these companies in this list, particularly between 2013 and 2020, the chart looks brilliant. And since 2020, the chart can go either way. Now, a lot of volatility when it comes to Nanosonic share price over the past few years. So this is telling us that the market is unsure about Nanosonics moving forward, even though the valuation of the company remains fairly high. There's probably a lot of short sellers out there who think this company is way overvalued, but at the same time, there's a lot of fund managers out there who see that potential of significant profit and cash flow growth over the next 5 to 10 years. And that's why, even at these valuations, Nanosonics is attractive. But between 2013 and 2020, this is a beautiful chart. Share price increased from less than 50 cents all the way to a high of $8. And that high in the share price was in 2021. And then the share price took a massive plunge, fell all the way back down at $3. And we have seen a nice rise in the share price since then. So again, this is a company I do have in my portfolio. I don't look at the share price every day for this company because it is a long-term hold for me, simply because I'm holding this company because of what I expect in this company over the next 10 years. So what the share price is in 10 years is more important to me than what the share price does on a day-to-day basis. Coming in at number 12 is a company I've never held at all in the past. And when you look at some of these numbers, I have to question, why have I not had a look at this company more in depth than I have done? And there is a reason behind that, behind my lack of excitement in this company. Talk about that in a second. But when you look at the revenue per share growth, 11.3% per year, earnings per share growth, 10.9% per year, and the dividend per share growth at 10.6%, those are exactly the sort of numbers you want to see for a company in your portfolio over the long term. I want to see at least 10% in each of those metrics. Gross margins, 13.9. So this is the reason why I have never held Data3. Really low margins. They have a pretty high revenue, sort of like Dicker Data. Dicker Data has really high revenues, really low margins, but sometimes a company can be high quality even if it has really low gross margins. A perfect example of that is Costco. And the whole moat of Costco in America is their low margins. That's how they beat their competitors. Now, if we go from the gross margin, which is 13.9, so that is fairly low. I'd like to see that a little bit higher. Return on invested capital is really good at 25.9. So if I focus more on the return on invested capital over the gross margins, perhaps I might have taken a position in this company in the past. And overall, this company has provided their shareholders a return of 25.2% per year. And that is a pretty good annual return. The sort of company you want to own, or the sort of returns you want to see a company own in your portfolio to have per year. One of the more interesting aspects of Data3, and this is quite unlike some of the other companies in this top 30 list, is that most of the share price appreciation has occurred in the last 5 years. So between 2013 and 2018, the share price of Data3 didn't go much. In fact, the share price went from, we'll say, about $1.25 down up to about $1.50. And then all of a sudden, the share price of this company took off in 2019. And the share price has increased from $1.50 to a current share price just below $7.50. So a nice six-bagger over the last 4+ years. So a nice looking chart for Data3. Now, the one thing I want to understand is, why did the market get excited about this company in 2019? Was it just the start of an increase in their margins? Perhaps that's all it was. Maybe the market wasn't impressed with the margins, really low margins, and they started to increase their margins. And with nice revenue growth, the profits started to expand at a greater rate than what the market might have anticipated earlier than that. So a nice story here for Data3, particularly in the last 5 years. Now onto the company that I was absolutely shocked made it onto the list. Coming in at number 11 is Elders. Now, to be honest with you, I would not consider this company to be high quality, simply because I would say it's cyclical, pretty bad revenue growth, negative 6.7% per year. And when you do a little bit of a analysis of this company, it just does not scream high quality. Now, the reason it made it onto the list will become clear when we look at the chart. But look at the revenue growth, negative 6.7%. Now, earnings per share growth is not applicable because 10 years ago, this company had negative earnings per share. And dividend growth is not applicable because 10 years ago, this company did not have dividends. In fact, they didn't have dividends for maybe 4 or 5 years. Now, gross margins just below 20%. So that is a little bit higher than Data3. And to be honest with you, I probably would expect gross margins to be fairly low for this company. Return on invested capital is a nice 12.6%. But the analyzed total return, 25.5% per year for those shareholders who have held onto this company over the past 10 years. And when I saw this company made it onto this, I went straight to the chart and went, No way. There's no way Elders made up to this. And then as soon as I saw the 10-year weekly chart, I went, now I understand. So let's have a look at the weekly chart right now. So exactly, almost exactly 10 years ago was the bottom of the cycle for Elders. So you'll notice the blue line, which is a 150-week moving average. Back in 2013-14, it was really high. So I expanded even further. And the share price of this company was significantly higher than it is now before 2011 or something like that. So those shareholders who have held in this company for like the last 15 to 20 years are still in the red. But the share price of this company moved into an uptrend in 2014 and remained in an uptrend from 2014 all the way through to the end of 2022. And now the share price of Elders has moved into a downtrend. And we have seen a significant drop in the share price of this company over the past 9 months. In fact, the share price of Elders has dropped from $15 to around about $6.50 to $7. So definitely the sentiment in this company has shifted from positive to negative, and the trend in the share price has changed as well. A lot of volume has coming in during the last few months because of this shift in sentiment. Some bad reports, bad announcements from the company have helped in that shift in sentiment as well. So again, my thoughts around Elders have not changed. This is a low quality company, but sometimes you just can ride these low quality companies when it goes from the bottom of the cycle to the top of the cycle. For Elders, it seems like that cycle from the bottom to the top lasted about 9 to 10 years. And that's all I have for this particular video, looking at those companies that came in between 15 and 11 on the 30 best performed companies on the ASX since 2013. Now, a few of these companies were not a surprise to be on the list, but there was one, and that is Elders. And that all comes back to timing. If I started this list in 2012 or 11, Elders would not have made it onto this list at all. So if you have any questions about any of the companies in this 15 to 11 list, I'd love to hear your thoughts. Or if you have any questions, just leave them in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.